This is financial entropy, and today we're investigating the systemic decay of long-term capital management. In August 1998, a single hedge fund lost $4 billion in 17 days. The Federal Reserve convened an emergency meeting of Wall Street's largest banks. Within 72 hours, 14 institutions had committed $3.6 billion to prevent the fund's liquidation. This was not a bailout. This was containment. The fund's counterparties included every major bank in the global financial system. The official explanation emphasizes the Russian default as an unforeseeable shock. The internal documentation reveals a different pattern. For 4 years before that August, long-term capital management had operated under the assumption that mathematical models could eliminate risk by diversifying across thousands of positions. The models accounted for historical volatility. They did not account for the disappearance of liquidity itself. Here is the mystery we will resolve. How does a fund managed by Nobel Prize-winning economists, staffed by PhD mathematicians, and overseen by experienced Wall Street traders lose 90% of its capital in a matter of weeks while following its own risk models precisely? The answer is not in the Russian default. It is in the architecture of leverage built on the belief that correlation breakdowns were statistically impossible. Part 1. The Arbitrage Illusion. Long-term capital management opened in February 1994 with $1.3 billion in capital. According to the firm's private placement memorandum filed with the Securities and Exchange Commission in March 1994, the strategy focused on convergence trades, identifying securities that were mispriced relative to each other and holding positions until prices converged to their theoretical relationship. The fund would buy the undervalued asset and short the overvalued asset simultaneously. When prices converged, both positions would close at a profit. This is arbitrage in its purest form. The returns do not depend on market direction, they depend on the correction of relative mispricings. If the math is correct, the profit is certain. The only question is timing. The intellectual foundation came from option pricing theory. In 1973, Fisher Black, Myron Scholes, and Robert Merton had published mathematical proofs demonstrating that derivatives could be priced using models based on hedging and no arbitrage conditions. Scholes and Merton received the Nobel Prize in Economics in 1997 for this work. Both were partners at Long-Term Capital Management. The models rested on several assumptions. First, that markets were liquid enough to enter and exit positions without moving prices significantly. Second, that historical correlations between assets were stable and predictable. Third, that extreme events followed normal statistical distributions. Fourth, that multiple arbitrage opportunities could be exploited simultaneously without creating portfolio-level risks. These assumptions held under normal conditions. Long-term capital strategy was to exploit tiny mispricings across vast scales. According to the 1999 report by the President's Working Group on Financial Markets, page 12, the fund's typical arbitrage spread was measured in basis points. A single trade might generate a return of 0.5%. To generate substantial profits, the fund required enormous leverage. Here is where the incentive structure shaped the architecture. The partners had committed their personal wealth to the fund. Their compensation came from performance fees on profits, not management fees on assets. The rational strategy was to maximize returns through leverage, while the models indicated risk was controlled. According to the fund's 1997 financial statement released during bankruptcy proceedings, long-term capital had equity of $4.8 billion and controlled positions with notional value exceeding $125 billion. The leverage ratio was approximately 25 to 1. This was conservative compared to the fund's off-balance sheet exposure. The fund used derivatives extensively. According to the Federal Reserve Bank of New York's report on October 1998 on the LTCM crisis, page 7, the fund's total derivative positions had notional value exceeding $1 trillion. Notional value is not the same as exposure, but it indicates the scale of interconnection. Every derivative contract had a counterparty. Every counterparty faced the risk that long-term capital could not honor its obligations. The fund's trades fell into several categories. One major strategy involved government bond arbitrage. The fund would buy higher-yielding government bonds and short lower-yielding bonds of similar maturity, betting that the yield spread would narrow. This trade assumed that government bonds of similar credit quality and duration should trade at similar yields. When they diverged, it represented an arbitrage opportunity. A second strategy involved merger arbitrage. When a company announced an acquisition, the target stock typically traded below the offer price until the deal closed. Long-term capital would buy the target and short the acquirer, betting the spread would close. The risk was that the deal would fail. The model calculated the probability of failure based on historical data. A third strategy involved equity volatility arbitrage. The fund would trade options against underlying stocks, exploiting mispricings in implied volatility. The model hedged directional risk continuously, isolating pure volatility exposure. The genius of the approach was diversification. Each individual trade had limited risk. Combining thousands of trades across different markets, different asset classes, and different types of arbitrage should reduce aggregate risk further. The correlation between government bond spreads in Italy and merger spreads in the United States was assumed to be minimal. The portfolio appeared safer than any individual position. This is the logic that created systemic fragility. Every trade was rational. Every hedge was mathematically sound. The aggregate structure was vulnerable to a single condition the models did not adequately incorporate: the simultaneous disappearance of liquidity across all markets simultaneously when the fund itself was large enough that its unwinding would trigger the very correlation breakdowns it had bet against. According to academic research published in the Journal of Finance in 2000, Volume 55, Issue 4, page 1537, long-term capitals trades typically involved purchasing less liquid securities and shorting more liquid securities. The fund earned a premium for providing liquidity to markets. The strategy worked as long as liquidity remained available when the fund needed to exit positions. The fund was not just trading spreads, it was short liquidity itself. The anchor thesis governing this investigation is as follows. Long-term capital management's collapse was not caused by a failure of mathematical modeling, but the structural impossibility of hedging against the coordinated withdrawal of liquidity across all markets simultaneously when the fund itself was large enough that its unwinding would trigger the very correlation breakdowns it had bet against. The models were correct about the mispricings. The mispricings did eventually converge. The failure was temporal. The fund ran out of capital before convergence occurred, and the act of liquidating positions to meet margin calls pushed correlations further away from their historical norms. The fund became the catalyst for its own destruction. Part 2. The liquidity trap. Through 1996 and 1997, long-term capital generated extraordinary returns. According to the fund's audited financial statements, net returns were 43% in 1995, 41% in 1996, and 17% in 1997. The lower return in 1997 was still exceptional by industry standards, but it indicated that arbitrage opportunities were narrowing. As more capital chased the same strategies, spreads compressed. The rational response would have been to reduce leverage or return capital to investors. Long-term capital did the opposite. In December 1997, the fund returned $2.7 billion to investors, reducing equity from $7.5 billion to $4.8 billion. The fund kept the same size of positions. According to testimony by partner Eric Rosenfeld to the House Banking Committee in October 1998, the partners believed their strategies still offered superior risk-adjusted returns and wanted to concentrate gains among themselves. This decision raised the leverage ratio significantly. The same absolute positions now rested on a smaller equity base. The fund's sensitivity to market movements increased proportionally. The first measurable escalation occurred in May 1998. Russia was facing fiscal crisis. Oil prices had collapsed from $20 per barrel in late 1997 to $11 by June 1998. According to the International Monetary Fund's World Economic Outlook of October 1998, page 23, Russia's federal budget assumed oil at $18. The revenue shortfall was catastrophic. The government faced a choice between defaulting on foreign debt, defaulting on domestic debt, or printing money to cover obligations. Long-term capital had no direct exposure to Russian stocks or Russian corporate bonds. The fund held positions in Russian government bonds, denominated in rubles. These were considered low-risk arbitrage opportunities. According to the model, Russian government debt should trade close to Western European debt of similar maturity once adjusted for inflation expectations. The spread represented an arbitrage. On August 17, 1998, Russia announced a unilateral restructuring of domestic government debt and a devaluation of the ruble. This was not a credit crisis. This was a sovereign repudiation. The Russian government had chosen to default on obligations to its own citizens rather than continue debt service. According to the Bank for International Settlements quarterly review of December 1998, page 8, Russian domestic bond prices fell 80% within 3 days. Long-term capital's direct losses on Russian positions were significant but manageable. The fund lost approximately $400 million on Russian exposure. Given equity of $4.8 billion, this represented 8% of capital. Painful, but survivable. The destruction came from contagion. The Russian default created a global flight to quality. Investors sold riskier assets and bought the safest government bonds, primarily U.S. Treasuries. This was rational individual behavior. At the portfolio level, it created a coordinated movement that broke every historical correlation long-term capital's models assumed. Here is the mechanism of failure. Long-term capital's arbitrage trades involved being long less liquid assets and short more liquid assets. When the flight to quality accelerated, the liquid assets the fund was short rose in price, while the less liquid assets the fund was long fell in price. Both sides of the trade moved against the fund simultaneously. In government bond arbitrage, the fund was long, higher-yielding European bonds and short U.S. Treasuries. Treasury prices surged. European bond prices fell. The spread widened dramatically. In merger arbitrage, target company stocks fell as equity markets declined, while the short positions against acquirers did not fully offset losses. In equity volatility trades, realized volatility spiked beyond anything in the historical data, causing option positions to lose value. The following analysis is based on available public records and the limited perspective of institutional archives. According to the President's Working Group report of April 1999, page 14, long-term capital lost $1.8 billion in August alone. The fund's equity fell from $4.8 billion to $3 billion. This triggered margin calls from counterparties. The fund needed to post additional collateral or reduce positions. Reducing positions required selling the very assets that were declining in price. Every sale pushed prices lower, widening the spreads further. The fund was trapped in a liquidation spiral. The models indicated the trades would eventually converge. Convergence might take months or years. The fund would be insolvent within weeks. If you're finding this analysis of market disorder valuable, subscribe to Financial Entropy for more investigative deep dives. The second escalation occurred in early September. Long-term capital attempted to raise additional capital. The partners contacted several potential investors, including Warren Buffett and George Soros. According to the congressional testimony by partner John Merriweather on October 1, 1998, the fund sought $15 billion in new equity. The negotiations failed. Potential investors recognized that any capital injection would be consumed immediately by ongoing losses and margin calls. The probability of recovery was low. By September 20th, the fund's equity had fallen below $1 billion. Losses were accelerating. The fund notified the New York Federal Reserve Bank that it faced imminent insolvency. According to the New York Fed's internal chronology released in 2000, the notification triggered emergency consultations among regulators. The concern was not long-term capital survival. The concern was contagion to its counterparties. The fund had derivative contracts with nearly every major financial institution. If long-term capital defaulted, counterparties would need to liquidate the collateral the fund had posted and close out derivative positions, which would dump massive quantities of securities into already fragile markets, potentially triggering margin calls at other institutions. Here is where systemic risk became visible. Long-term capital was not too big to fail in the traditional sense. The fund had no depositors, no retail customers, no payment system role. It was too interconnected to fail. The web of derivative contracts meant that the fund's liquidation would immediately become every counterparty's problem. On September 23, 1998, the New York Federal Reserve Bank convened a meeting of 14 major banks and securities firms in its offices. According to the minutes released under Freedom of Information Act requests, the meeting lasted several hours. The message from regulators was clear. Long-term capital's disorderly failure would damage the financial system. The firms should consider a private sector solution. The banks faced a coordination problem. Each institution had exposure to long-term capital. Each institution would benefit from an orderly resolution, but no single institution wanted to contribute capital while others free-rode. The Federal Reserve provided the forum for coordination, but contributed no public money. By the evening of September 23rd, 14 institutions had agreed to contribute $3.625 billion in exchange for 90% ownership of long-term capital. According to the consortium agreement filed with bankruptcy court in 2000, the original partners retained 10% equity and would manage. The second parallel appears in central bank policy. Since 2008, central banks have suppressed volatility through asset purchases and forward guidance. According to the Bank for International Settlements Annual Economic Report of 2024, page 57, volatility across equity, bond, and currency markets has been below historical averages for most of the past 15 years. Low volatility encourages leverage. Strategies that harvest small returns through large positions become profitable. The system becomes dependent on volatility remaining low. This is the same structure that destroyed long-term capital. The fund's arbitrage strategies were profitable because volatility and spreads were predictable. When volatility spiked, the strategies failed simultaneously. Today's financial system has built larger positions on the assumption that central banks will suppress volatility. The question is what happens when volatility returns and cannot be suppressed. The observable systemic risk signal today is the concentration of similar strategies across institutions combined with leverage calibrated to recent low volatility conditions. When models across the industry assume similar correlations, they will produce similar trades. When stress occurs, those trades will unwind simultaneously. The more institutions use quantitative models based on historical data, the more likely that models will fail together. The defensive awareness behavior is to observe not whether markets are calm, but how much leverage and position concentration has been built on that calmness. Stable markets are not proof of safety. They are the condition that allows fragility to accumulate. Long-term capital's positions were most concentrated in August 1998, after 4 years of stability and model validation. Here is the final recontextualization. Long-term capital did not fail because its arbitrage trades were wrong. The firm failed because it was large enough that its own liquidation moved markets, creating the losses it was trying to avoid. The models assumed the fund was small relative to market size. This assumption was correct when the fund started. It became false as the fund grew and as other other institutions adopted similar strategies. The partners were not reckless. They were brilliant mathematicians who built sophisticated models and tested them against historical data. The models worked until the environment changed in ways the models did not contemplate. Specifically, the models did not contemplate a scenario where liquidity would disappear simultaneously across all positions because the fund itself had become a systemic source of that liquidity. At Financial Entropy, we analyze historical patterns to understand modern risks. Hit the bell to track the disorder with us.